FHA versus conventional. Which loan is best for you? We'll go over them once we get back. So for a Federal Housing Administration or FHA loan is insured by the federal government. First-time home buyers and those with lower credit scores, such as 580 or higher, and has a lower down payment are likely to qualify for an FHA loan. This can be enticing to some borrowers because the minimum required down payment for an FHA loan is only 3.5% of the purchase price. By contrast, a conventional loan is not insured by the government and instead backed by a private mortgage lender, and the borrower usually pays insurance. And so conventional loans can be hard to qualify for and require the buyer to have a higher credit score of at least 620 or higher. Typical down payments for conventional loans are around 20% or more, but can be as low as 3%. But even though a 3% rate is possible for a conventional loan, most opt to put more down to avoid mortgage insurance. When someone buys a home and does not have at least 20% saved for a down payment, mortgage lenders want to protect themselves from risk if they can't repay the loan. That's the reason why they require borrowers to pay mortgage insurance, which protects the lender from a loss when the borrower can't repay the loan. So for FHA loans, it specifies that borrowers pays two kinds of mortgage insurance: a one-time upfront mortgage insurance premium and a monthly mortgage insurance premium. The monthly mortgage insurance premium is generally required for the life of the loan. So for conventional loans, private mortgage insurance, also known as PMI, can be canceled after 20% equity in the home is achieved. But as I mentioned earlier, FHA mortgage insurance typically lasts the entire life of the loan. But also keep in mind that you can eventually refinance your FHA loan into a conventional loan. That will no longer require you to pay mortgage insurance. It's especially beneficial to refinance your FHA loan if you have 20% equity in your home, which will enable you to remove the lifetime private mortgage insurance and resulting with you saving money in the long run. So you can eventually refinance an FHA loan to a conventional loan, but it requires meeting minimum requirements. And one of those is the debt to income ratio, also called DTI. So it's a percentage that tells lenders how much money you spend versus how much money you have coming into your household. You can calculate your DTI by adding up your monthly minimum debt payments and dividing it by your monthly pre-tax income. Conventional loans usually allow a maximum DTI of 43%, meaning your debts take up no more than 43% of your gross income, while FHA loans allow more generous 50%. When you apply for a mortgage, you'll need to meet maximum DTI requirements so your lender knows you're not taking on more debt than you can handle. And lenders prefer borrowers with lower DTI because that shows less risk that you'll default on your loan. As for loan price restrictions of 2020, the FHA floor was set at $331,760,000 for a single-family home loan. This minimum lending amounts covers about 80% of all U.S. counties. FHA ceiling represents the maximum loan amount. For a single-family FHA loan limit in Los Angeles and Orange County, the ceiling is at $765,600. And there is no limits for conventional loans. So in summary, an FHA loan is more flexible to obtain, but no matter how large your down payment, you'll have to pay mortgage insurance. Whereas a conventional loan requires a higher credit score and more money down, also does not have as many provisions. Well, that'll do it for today. I hope you found this info helpful. If you have any questions, you can DM, text, or email me. Thanks for joining me, and I'll see you in the next video.